Hello everybody out there. Joseph Smith here from Travel Tax, and we are now in our first week of tax season. Anytime Super Bowl comes up, it's usually an indicator that things are about to get busy around here in the office. One of those common questions we're getting now that everybody's getting their W-2s is, what states am I supposed to have withholding at? There's a lot of confusion surrounding this, and let me give you the big picture. When you work in other states, your home state is going to tax everything you earn anywhere. It does not matter that you didn't work there. You are a legal resident there and therefore obligated to pay that state's tax on your global income. Now, when you go work in another state, they're going to tax it too because you're physically earning that income on their soil. So that tax that you pay to them, or better, that tax that we determine you're obligated to pay them when we file the return, is allowed as a credit against your home state return up to the amount that the home state would regularly charge on that same income. So when you're in a situation where your home state tax is higher than your work state tax, guess what? You have an additional amount to pay. And if you don't have enough withholding for the home state or estimated payments, then when you file your tax return, it will show an amount due. A lot of people make the mistake that, well, I'm going to a non-resident state because I don't live there, I shouldn't pay taxes there. And that's not the case. So the worst thing you can do is try to file exempt in that other state thinking that their taxes somehow just going to go away, and that's not the way it works. That's also a license issue because they're being authorized to work in that state, and all of the state revenue agencies generally will cross-reference professional licenses with filed tax returns. That's especially true if you're a resident of a compact state. So the home state is going to have the final say here. And when you file your returns, you've got to go through the whole rigmarole of filing every state that you worked in before filing in the home state, so you can determine what kind of credit that is. Now, everything I just told you is general. There are some specific situations in which that same kind of formula doesn't apply, and there's two of those. And one of those is reciprocity states. Especially if you live in a state like Ohio, it has a border agreement with every state that it borders. If you are in a reciprocity situation and you work in that state's not going to tax your income, it just defaults to the home state. And then the other one only applies if you are a resident of Virginia, Indiana, California, Arizona, or Oregon. And that little 5-state grouping, if you live in one and work in the other, then it's the work state that's going to give you credit for what the home state charged, not the normal method where the home state gives you credit. Now, within that little grouping, you live in one and work in the other one, there's one little exception inside that grouping, and that's Indiana and California. So if you're an Indiana resident working in California or vice versa, you go back to the normal formula. That's why multi-state tax is so fun. It's got all these little exceptions to the rules. But that's what we're seeing right now. We'll be posting up some other videos down the road here. And it's February 1st. Super Bowl's tomorrow. I hope your team wins. Or if it's not your team, hope you enjoy all the food and fun. We'll talk to you later.